Good evening, everyone, and a warm welcome. Really excited to be part of this conversation where we are going to talk about something really fundamental. We always believe that economic growth or economic story translate into wealth creation opportunities for our investors. And when we talk about wealth creation, two segments of our economy or two investment instruments or financial instruments which play an important role are infrastructure investing. All of us have been listening to infrastructure investing and the multiplier impact it creates in the economy for the longest period of time. And second, equity investing. On the face of it, it looks slightly different because when you are investing in infrastructure asset which is generating cash flow, you are monetizing the cash flows from that asset. When you are investing in equity, that time you are trying to benefit from the profit growth that is generated by the company. But whether it is a high growth stock or highway asset, both of them participate in economic activity and create investors return. Large part of the benefit to these asset classes accrue based on the economic environment and the kind of growth impetus that we have. So I'm really excited to have this conversation with Ganesh and Subahoo. And in the recent past, we had a good fortune of having conversations around this topic. And Ganesh, especially, I remember the last conversations where we debated about four engines of the economy and how each of these engines are working right now. We spoke about consumption, government capex, private capex, and global trade. And you had a very strong view that in India, at any point of time, only two or three engines can work. Anything more than that will make the economy really inflationary. Any thoughts on why some of these engines are working the way they are working now, and where we see India's economic impetus coming from over next 3 to 4 years? We spoke about how this transition has happened from investment-led growth to a more consumption-led growth. When we see government spending money on giving tax reliefs or GST tax cuts, all of that has led to some positivity in consumption. In fact, a lot of positivity, especially in consumer discretionary spending. So how do you see this translating into some of the equity market opportunities going forward?
Good evening. It's great to be here. Thanks for the invite. Uh, as I said, in India, if you've seen the pattern over the last 25 years, these four pillars of drivers of our earnings growth, our economic growth, all four have never fired in any year. Okay. At the best years, say 2003 to 8, three engines were firing. In the last 3 years, you didn't have consumption wasn't firing, it wasn't misfiring, but it was like okay-ish territory. Oil prices were low. India was doing very good efforts on import substitution. Software, GCCs, which is basically services exports, were doing well. And that was creating employment and that was helping things. Government capex was outstanding, recovering from COVID. The number of cities, India's, you're seeing metro work, number of airports coming up, the roads, activity, that was creating employment and earnings growth. And corporate capex was moderately picking up. So we actually had a pretty good drivers of growth recovering from COVID. But in the last 12, 18 months, that was beginning to stutter a bit. Especially in the last 12, 15 months, you found government, especially state government capex, almost becoming flattish. You had corporates getting wary and they were not spending on capacity expansion. Consumption was not picking up. In fact, it was slowing down and a lot of measures are now being taken. And but the import substitution continued to do well on electronics import substitution or even on various services exports. We were reasonably okay. So the construct changes almost every phase of 3 years, and that drives earnings growth, that drives the economic activity, and we need to look at cycles on that, keeping those in mind.
Oh, absolutely. And Subha, we also had an interesting conversation around big themes which are likely to play out over next 15, 20, 30 years. You said decarbonization, digitization, and manufacturing growth. All of these tie back into what kind of wealth creation opportunities are there in front of us. And since you also look at investing in real asset, how does that get impacted because of some of these themes which are playing out?
Yeah. So first of all, I think for a lot of people out here, I think thanks for coming. But let me first talk about what does real asset mean, because I think people understand equities, people understand mutual fund, but real asset has been a new topic in India in the recent past, right? So real asset is basically an asset which has cash flow, which is long term, right? So it is an asset which is already generating cash flow long term. It is a value which is there, but it also has contracts or concessions which is giving long term cash flows, right? So the asset class works on cash flow and not on growth, right? So it's more predictable, it's more stable, and hence it is lot more boring than equities, right? So once you've invested in that asset, you look for a very steady, stable, long-term cash flow income. From there, it's a bit more boring, but it's also more exciting when it comes to the private markets. So in India, the real asset as an asset class was predominantly played by global investors, right? So we all have heard of name of Brookfield, Blackstone, KKR, Actis. All of them came into India since 2010, 11, 12. And they are the guys who actually started investing in real asset in India. Right? And once they've invested from the fund, created a portfolio, then they listed it as a InvIT or a REIT. Right? So you have InvITs like Integrate, which is owned by KKR, you have Brookfield REIT, or your Embassy or a Knowledge REIT, and things like that. Right? So what they've done is they bought an asset which is available at a relatively cheaper valuation. They've created into a large unlisted portfolio where the value enhancement happens, and they're finally listed in the market. So think about an equity that the public market will trade at a premium than a private market, right? But you have to create a portfolio and then list it. And that is how they generated an alpha over the listed market. Listed market does give stable, consistent long-term return, but the private market gives higher return, higher MOIC, but it is illiquid in nature, which means a lot more patience and lot more longetism required on that.
Oh, great. Thanks for this explanation. So,
but I will add to the themes, I think, which is your question, right? That was how to explain real asset. So in India, I basically say there are 4 mega trends which is playing out. One is energy. We are 1900 billion units of electricity consumption. We grow by 6.5 to 7%. Everything which is manufacturing, everything which is data center, our mobiles, household, everything requires electricity, everything requires energy, right? And that is a bigger growth which is there. So our annual consumption is growing higher than US. US is 4,900 billion units. They grow at 2.5%. We are 1,900 billion units of annual consumption. We are growing at 7% annually. So our annual consumption growth is higher than US market, right? So that is a big segment. And we saw some charts in the previous panel where energy, the market cap or expansion, something I think which was shown. But that is one mega trend which is happening. The second mega trend, I think, which we all have spoken about and we have heard about it, is around consumption and manufacturing. The third one is around digitization, right? So India is young population. We are consuming a lot of data. Our data per capita is increasing. So there is a digitization. And the last one, I call it as democratization. And that's what I call it as 4Ds. And democratization is basically means the private assets are becoming accessible to now ultra HNI and HNI through InvITs and REITs, which was otherwise not available. Right? And these are the 4 very, very large mega trend. It plays out in equity market. You can invest into a growth company, or it can also lead into asset creation, which is long-term cash flow oriented.
Interestingly, I was looking at this data, and we have been a big beneficiary of investing in some of the REITs and InvITs through our debt strategies, where we've seen significant capital appreciation over last couple of years. When I compare Indian markets with US markets, the size of REIT and InvIT markets is extremely small in India relative to our size of the economy. When I look at government's national monetization plan, there is about 10 lakh crores worth of monetization plan which is there. In US, $4 trillion worth of market cap is there with REITs, which is almost 12.5% of the GDP. In India, we have about $20 billion, which is about less than 1% of our GDP. So, how are we going to bridge this gap? And what are some of the exciting opportunities which are appearing? We are seeing gas pipelines getting monetized. We are seeing power transmission assets getting monetized. Ports are getting monetized. So, there are opportunities across the spectrum. How do you play these opportunities, and what are the safeguards that we need to keep in mind?
So I'll give an analogy of equity, right? When equity started in India, I think way back whenever 30, 40 years or 30 years back, right? Everything, so an investor, any Indian citizen could start participating in a pharma company, in an IT company, in a chemical company by buying into equities, right? And that was the era of financialization of those companies or democratization of those companies through equities. And that is what is happening in real assets, right? So everything which you see an asset which is cash flow generating will get democratized just like equities. Underlying assets could be different, the cash flows could be different. So not all InvITs are same, not all REITs are same. US started the journey in REITs in 1960s. MLPs came in 1991 and yieldcos came in 2014, right? We are way behind in terms of the product as it evolved. And thanks to SEBI, I think that started in 2015, 16, they started developing the product. In 17 is when the first InvIT got listed, and 19 is when the first REIT got listed in India. But we are seeing only few asset class currently which has got listed, right? So residential flats are also REITs in US, because what it gives to any investor is diversification. You don't need to invest in a physical property. You will have, let's say, 100 flats or 1,000 flat portfolio. Someone else is managing, leasing it out, giving the rent income as income distribution, whatever capital appreciation getting reflected in NAV, but you have diversified asset portfolio. You can decide what check you want to invest, when you want to take out. It is not location specific. It is not size specific, right? So everything which is an income producing asset will get monetized, will get into REITs and InvIT. It is just a journey which has just started. Despite that, the journey started just about 10 years back. The REITs and InvIT AUM has gone to $100 billion combined, right?
Private plus
Private plus public. Private plus public, which has gone to $100 billion. And to give you a data point, the AUM of what REITs and InvIT has today, it took mutual fund industry to get there 20 years. Right? So mutual fund regulation came in 1995. By 2016, they reached the same AUM as where REITs and InvIT has reached in close to about less than 10 years. So this is growing at a very fast pace.
We really like this asset class. We believe that it gives you benefit of both equity as well as debt. It gives you recurring cash flows. At the same time, there is a potential upside also. So we really like this asset class, and strongly believe that investors should have allocation to this asset class in the portfolio. On the infrastructure, staying on infrastructure, Ganesh, you have been a contrarian investor, and I remember in 22-23, you had a very positive call on real estate when nobody was looking at that as an asset class. I had two questions for you. First, would you invest in the equity of real estate developer, or would you own the assets and benefit from that? Obviously, there are always skepticisms around investing in real estate developer and their companies, but performance has been spectacular, and On the other hand, infrastructure investing or holding real assets have also done well for the clients.
So this real estate cycle that we are in is very unique in the sense 20 crore, 30 crore houses are being sold literally over a weekend, and 40, 50 lakh houses are left unsold. Okay. We have had that kind of a real estate cycle where equity markets gains made here through ESOPs, through IPOs, through gains made in stocks are finding its way into premium property. So the answer to the question that you asked about the property cycle, I think property cycle will do well if equity markets do well. Okay. If capital gains made on equities moderate, as it has moderated in the last, say, maybe year-on-year markets are flattish, maybe 10% of the stocks have given absolute returns and others are flattish, capital gains doesn't come and that doesn't get shifted into property. But mass housing, for that to recover, I think the seeds are being sown now. Okay. Through all the initiatives that the government has started. Now this is not enough, and I genuinely believe that the last 12 months you see the initiatives government has taken, be it income tax rate cut, slabs sometime back, interest rate cuts through by RBI through the year, the real money gaming bans, money shifting from gaming to consumption, the GST rate cuts, the tightening on all the FNO restrictions which have come about. The focus of policymakers is to shift the pattern of consumption, put more money into the pockets and let that find its way into the real economy as pickup. And cement duty cuts from 28 to 18% or in various durables and all the it won't play out immediately. It may play out festive season, etc. But for me, the key next 3, 4, 5 year expectation is mass housing picks up, and it's not just 30, 50, 80 lakh houses. It's about that adding a room in a rural, adding a floor, independent self-constructed houses, that actually drives a lot of activity. And also keep in mind that almost 45% of what government spends as capex, be it in a road or a new railway line or an airport, is actually buying land. It's actually buying rural land. And whose land is it they're buying? They accumulate, and it's somebody's hand, and that is again income which finds its way into consumption. So intricately linked. But my expectation is mass real estate cycle has to pick up. I think the premium side of real estate is going to be very cyclical, and I think we have had an extraordinary last 3-4 years. I'm not too sure that extent of returns or that extent of premiumization in property will continue over the next 3-5 years.
You still not answered my question. Whether to hold real estate or equity of real estate developers.
So I mean, as an equities man, I mean, I will always say equities. But I actually think this time around we need to be betting more on what we call, or we always call as the picks and shovels strategy. Okay, which is buy the indirect beneficiaries, right? Buy building materials, buy tiles companies or pipes companies or wood panels or it could be cement for sure, or indirect proxies are much better than property developers. The nature of the business cycle, business model of property developers, it's very finite project-led cash flows, and it tends to be very cyclical and lumpy. So character-wise, we prefer the picks and shovels approach of what kind of indirect beneficiaries you have rather than the asset developers.
No, absolutely. Real estate. Yeah, sorry.
I just want to add on that. I think it's not a choice of either do an income producing asset or do an equity. It is actually going to be a combination of both, right? Because as an investor, you like to create a portfolio on equity, you like to create a portfolio on income producing, yield generating, which gives you regular cash. So it is ultimately going to be the portfolio creation. Someone who is want more alpha, little more aggressive will do more allocation to equities. Someone more balanced will do both. Someone more conservative will do more here, right? So it's all about portfolio allocation and the nature of the investor.
No, absolutely, and that's an important point. It's an individual allocation which each investor need to customize to their own requirement. Very interesting data that we were discussing was slump in the credit growth. There was a tremendous amount of slump in credit growth which happened for 16 to 18 months in Indian economy. RBI created liquidity deficiency in the system and which created its own set of issues and which in turn created a prolonged slowdown in economy. Now we seem to be coming out of that. But one interesting development which happened during this period was the whole advent of private credit funds. And private credit funds have started lending directly in large quantums to some of the largest corporates now. Now, obviously, that is a large industry in the US. Would love to understand your thoughts on how private credit has been functioning in India and how it's likely to grow, especially in the context of RBI making it easier for banks to do acquisition financing now, which has been a big area of focus for private credit funds.
Yeah. So let me take your last part of the question first, right? So private credit market. So let me first define private credit market. Private credit market is what banks can do. That is one segment, which is bank is allowed to do. They can do, which can give them regularly monthly interest payment, right? Bank cannot do which doesn't give them monthly interest payment, right? Then there is an NBFC market, and then there is an AIF market, right? And all of that is called as private credit market. Now, the more you move towards alternative private credit, it requires more capability because that's where the cash flows are not regular in nature. There will be low coupon, high pick, right, which is at the end. There could be possible equity upside participation on an operating profit participation. So it requires much more capability to analyze those companies from a private credit market perspective because you are giving money which a bank and NBFC cannot provide. Right. So when RBI has done this change around allowing Indian banks to provide capital for acquisition, it is actually they have taken the competitive advantage which foreign bank had over Indian banks. It's not with the private credit funds. It is actually taking the or balancing the competitive advantage between foreign banks and Indian banks. Foreign banks were the largest credit provider for acquisitions in India, right? All the large foreign banks, whereas private credit has been solving for the need which is not being met by the banks, right? So it could be for the purpose of stake enhancement, it could be for the purpose where you have profitability getting ramped up and you are doing capex and expansion, or it could be for some other reasons. But I think that requires a lot more capability to understand what credit you are giving, how you are secured, what are the covenants, and active monitoring. Bank will not be able to do active monitoring to that extent, right? Because they have a large book and they are not having small exposures or a small number of portfolios. So private credit in AIF is very different from what a bank does.
So we saw early signs of revival in credit offtake and started increasing allocation to banking and financials in our portfolio somewhere around Jan and Feb of 2025. So Ganesh, we discussed about allocation to banking and financials, and you had a strong view on that and how credit is going to revive and which segments of the economy will see revival and which segments will continue to struggle. So
Yeah.
would love to know your thoughts on that.
Sure. See, this corporate credit cycle has been very internal accruals and equity funded after the mishaps of the previous NPA cycle or the excess leverage the corporates took. Banks have become very corporates have become very so, and the way the corporate balance sheets are looking today, the levels of cash, the kind of cash accruals they will likely get, and the options of being able to raise equity or alternate sources. I don't think this cycle is going to be a corporate credit fueled cycle. I think it's going to be an SME and retail credit funded cycle. And to that extent, 40% of the overall credit loan books of banks will likely grow maybe mid to late single digits, whereas the SME, mid market, or retail, that should be growing in maybe mid teens. What's been a challenge, as you rightly said, is there post COVID, especially in FY 22 and calendar 22 and calendar 23, there was some kind of euphoria or some kind of indiscipline building up on unsecured loans, microfinance, personal loans, credit cards, etc. So RBI stepped in, and around 24 and the last 12-18 months, they have tightened, and that element, that part of the loan book for both banks and NBFCs have moderated. I think to a large extent that pain has been resolved. My expectation is now the money being put into people's pocket will also go in the year one into deleveraging before it goes into re-leveraging cycle picks up. So in the next 12 months, I think it will be deleveraging of mass household balance sheets who have taken debt now, the lower tax, and that will go into it. And as we go into later half of this decade, I think they will re-lever. So to answer your question, credit growth will revive, but it will be led more by retail and SME. On SME, there are two big material landmark changes which are happening, which is one was GST related data, which banks started having access to till about 2021. Lending to SMEs was security based, not cash flow based. Now it's data, GST returns available data. Second is shopkeepers or the small, even the panwalas or almost any small micro businessman is giving UPI. Okay. And that means banks have access to level of cash flow for that even the smallest shop is now able to access. I think in the next 5 years, banks which are today just accumulating a gold mine of data will use it to lend, will actually be having pre-authorized limits based on what that shop is getting as monthly cash flows. And I think SME is where the banking credit will pick up in a large way into the next 5 years.
So we also had a similar view of saying that with all the liquidity which is coming in the hands of the consumer, there'll be a multiplier impact. People will borrow money and service their EMIs with this incremental saving which is coming. So personal loan growth should start picking up again, and that's what is visible in the numbers also. So I was thinking about Pune, and Pune has three large industries, defense, automobile, and IT. And defense and automobile have contributed to some of the most defining innovations which have happened in the world. Whether you talk about GPS, whether you talk about radar system, jet engines, nuclear energy. Yeah, you think of all the landmark innovations which have happened in the world have come from these two industries. Pune in itself has also grown. So what is your take? And both of you would have invested in Pune. What is your take on where are the opportunities to invest in Pune for the investors, both in terms of real assets and in terms of sectors or segments of the market where they can find opportunities?
I mean, two things here. One is one of our most important calls that we took when the first COVID wave was winding down around early 21, was this decade is about manufacturing. Okay. The previous decade was it was IT and we've had various other, but in our opinion, import substitution and manufacturing will be the very large focus area for us as investors, as because the runway for growth was huge. And give you some examples. When Geo Telecom got launched in a large way around calendar 17, 18, and that year, India's electronics imports went up to almost 60 odd billion dollars. Okay, almost negligible exports. I'm talking cell phones mainly, but also laptops and anything to do with electronics that we all have. Come to today, okay, we have managed to, in just 5 years, the what we have done on cell phone manufacturing, the Apple is telling us that almost all the phones that they've sold in the last 6 months were manufactured in India. Foxconn, in the city where I live in Chennai, Foxconn has more than 10 manufacturing facilities having more than 1 lakh jobs. Okay, and almost 95% of them are women. Okay, and they work 2 shifts and the rub off. So we have managed to make exporting out of India, and this was actually a seminal change in India's, and I think that is giving confidence both to various other sectors where we are still massive China importing toys and plastics and almost everything. I think substituting that, and Pune is very critical as a city because it is a manufacturing hub, and it's not having the costly real estate of Mumbai, but close enough to the port. Okay, and that is an locational advantage. Engineering talent is another advantage. So ports, engineering talent, these, and not far from a city like Mumbai, gives it an edge. And so you will find manufacturing companies more and more having focus area on Pune.
So, what GCC and data centers are becoming a big theme, and we saw a number of GCCs and data centers which are getting established, and Pune is at the forefront of some of these benefits. How do you see that space evolving?
So I will partly also touch the question which you asked previously and this question as well, right? So, see, when we look at a real asset strategy, I think we look at assets which have multiple drivers around it, right? So let me take an example of manufacturing and consumption. If we invest into a highway asset, right, because the goods have to move. Somewhere it is getting produced, somewhere it's getting consumed. People have to move. We are agnostic, therefore, whether it is automobile, it is agri, it is chemicals and things like that. In fact, we like those assets which have diversified cargo mix, which is moving on that highway, because that's where you create diversification, right? So real asset is all about having that mega trends around it, but that asset being made useful for multiple sectors so that it has diversified legs to stand on cash flows. Whether it is, as I said, highways, whether it is energy, you can supply energy to any manufacturing setup or even data centers which are coming up. Coming to your question, second question on data centers, right? I think the data center or digitization, the whole digitization in India is going in a big way. However, I think the quality of data centers, in my view, and that is my view, is that the quality of data center which we have historically is not going to work in terms of going forward. What is the kind of design? What is the kind of energy consumption the newer data center is looking for? Right. And that is one more factor which happens in real asset. Right. We have seen how office buildings have changed. What it used to look earlier and feel earlier. How is power plant which has changed, or how is malls have changed. Right. The same way the older data centers are not going to remain viable, and the newer set of newer design of data centers will come. So that is a big opportunity. What I think was also talked about is that one of the biggest strength India has is we have the largest number of STEM graduate getting graduated every year in the world, which is English speaking. China is the largest, India is the second largest, but is the largest in terms of English speaking population. And what is driving that is all these GCCs, Global Capability Center, which are coming into India. Right? For example, JP Morgan has the second largest employee outside US or largest employee outside US in India. They don't do banking in India. They have 60,000 employees in India. There are a lot of those GCCs which are coming up. They are doing innovation, right? So I know like many companies have office in Pune where they do design and engineering for solar plant for the whole region, which is not just India, but India, Philippines, Vietnam, Middle East. But the design and engineering is happening out of Pune. And that talent pool is actually going to be the biggest driver for the capability which is India is having, the kind of work which we are going to do, and hence that will drive the whole digitization and the data center growth, which is going to it happens. So offices will become a very good asset class to invest in. Data center, of course, but everything has to be looked at in the lens of whether this is with new standards or they are at old standards.
Sure. What really changed was a few years back, government told the Googles and the Facebooks and the other tech companies, global tech companies, to store India data in India, okay, and not store it in Singapore or where they were earlier being stored as in data centers. So that's what prompted the data center build up in India, and this happened after the India-China skirmish, and where India became a little wary of China having access to data about India. Okay, so this is the origin now, and that throws up a very unique opportunities as stock pickers for us because you know, data centers need. India has a tropical weather, as you know, right? Data centers need 18 degrees air conditioning. Okay, it's a great opportunity that you can have mega-sized, massive air conditioning requirement, and air conditioning companies benefit from it. One, or the intensity of cabling which goes in, or switch gears, or so. For me, data centers has been a very interesting, very large, hitherto unavailable opportunity which came up, which has been, it's almost nascent in India. And I where the undersea cables land. So one of the reasons why Vizag is seeing a lot of activity on data centers is the undersea cables land in Vizag or in Chennai or the coastal cities, right? So data farms are coming up there. I mean, there is a 250-acre data center coming up in near Vizag, right? So those are all, we didn't have such opportunities earlier, and that's actually giving a lot of fillip to our demand for these. Again, I go back to the picks and shovels. For me, that's a very, very important indirect proxies, beneficiaries that I always keep trying to look for.
No, absolutely. Wires and cable companies reported record profits in this quarter, and most of this has come because of demand for industrial cables. So obviously, it speaks a lot about the kind of benefit which are accruing because of data centers coming up in India. Great. Really glad that we heard such optimistic tone about India. For last 12 to 15 months, everyone has been pessimistic and thinking about optimism and why we need to be optimistic in India. Churchill's quote of World War II is very relevant in this situation, that an optimist will find opportunity in difficulty and a pessimist will find difficulty in an opportunity. So with this thought, great, thanks for joining us for this insightful discussion. We are happy to take a few questions.
Hello, sir. Thank you so much. My name is Manav Nar. I love the topics you guys have discussed. I'm really young. I'm still exploring the world of business, manufacturing, everything. My question I wanted to discuss specifically was when you talk about manufacturing, R&D, innovation, especially here in Pune, a lot of products are not being newly developed or cost optimized because we fear that it will be copied by someone in Pune, someone in Rajkot, someone around the country or someone in China or an importer here in India who will import. So what protects a private business in manufacturing or product development which serves to the retail and consumption is intellectual property. Now, intellectual property in India has not been great at all. Neither the application of it, the timing of that happening, and the enforcement. No one really respects it. Neither do big companies do respect it or private players respect it. So I just want to get a few knowledge and insights or your thoughts on how intellectual property for manufacturing, product, retail, and distribution could be an advantage. How we can leverage enforcement in that situation, because I'm going through something like that, and that will definitely help people to invest in manufacturing and new product development rather than fearing ki how can we make sabse sasta or something that is only dependent on sales. Thank you.
I'll reply with what I'm seeing in one specific segment, which is the CDMO segment. Okay, contract within the pharma, you have generics and others. You have the penetration of generics is about 50% almost, largely penetrated. For in CDMO space, India has a very long runway for growth. And why global giants are looking at India for contract development manufacturing is actually the point that you said, because they are worried about IP theft in China. I've spoken to quite a few and heard many on conference calls. They are worried about chori in China on anything called IP, and that actually makes them want to diversify. And one of the very few FDA compliant manufacturing facilities with less fear is actually India. So it is not in absolute terms, it is relative to China that we need to evaluate. Are we less, is IP safety more here relative to China? That's where the global companies are thinking.
Just a quick follow-up to that. Absolutely. From the global and investment point of view, that is right. But when we as an investor or a business are trying to create intellectual property within the Indian jurisdiction, the Chinese jurisdiction doesn't matter. We have the patent for a product since 2018. The same product is patented in China in 2020. So they do not respect or care about the other boundaries. My only concern is how can Indian businesses within India use patents or design rights and product rights to enforce that, to really create a market share. Because we want to invest in companies who are also leveraging IP within their own domain. So I want to get a little bit idea of how you perceive enforcement within India to be a leverage point for anyone.
So maybe, while I don't understand the IPR subject that much, but whatever limited I understand is how can you patent your process for the design, and whether you can go for an international patent, right? There are a lot of companies I know in Pune which have gone for patents, which have gone for either their product or their processes they have got patented, and perhaps I think that might have protected them. Like, well, I know many companies in Pune which are in technology space, but they have gone and patented their processes or their products. But you have to go for an international patent for that to be enforceable.
Great. Thanks, Ganesh. Thanks, Subahoo, for doing this for us. This was a very insightful session for us. The biggest takeaway is money is energy. Put it to productive use, which will create economic energy and create wealth for all of us. So that's the biggest takeaway for us from this discussion. Thanks for doing this for us.